情，生不懂啊。
We'll see you around the timeline. Feels good to be back.
I think the Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
Let's go, baby. Happy Friday, Rob.
Hey, Market to everybody.
Welcome back to the Tokenization Tower.
Welcome to the program. It feels good to have this positive energy in the Rollup once again.
Yes, sir.
Yes, sir. Welcome back to the nest by our friends at Plume, the tokenization tower, here live from the center of the financial capital of the world. It is 12:35 p.m. Eastern time, baby. Let's give some love to all the production team behind the scenes, cooking everything up. We got a new light set up today, Rob. It's fired up.
I can tell.
It's bright as hell. Man,
Beautiful.
well, what's going on, man?
I mean, you got a beautiful view behind you. That's why we have the lights up, so it's good to see.
Yes, sir.
It's green on the markets. We're going to talk more about that.
Hyperliquid. Yes, sir. Yes, sir, Rob.
Look,
we got the lighter founder on today.
Yeah, that should be fun. And we're going to talk about Hyperliquid, and we're going to talk about perps in general. I mean, I think it's worthwhile just bringing up the overall just bullish nature in the air. Like, personally, I find it's just easier to just stay bullish all the way through the bear so that you don't have to switch biases.
Nah, I don't know. It was nice being bearish the last couple months.
It was nice being bearish.
Yeah. I mean, it gave you a sense of reality and not of hope, you know? I think that's important. I think you should be operating in a world not of hope, but of in reality.
I guess. But for a while, if you have a long enough time horizon, then you just stay positive, and that is the reality.
I mean, hype at 42, something to get excited about. I'll tell you that, guys. It looks like we're about ready to go right up to the 50s and higher. We're going to talk more about that. We're going to talk more about what's going on in the markets, what's going on in DC, what's going on with World Liberty Finance. On today's show, we're live from the Tokenization Tower. We got the markets and weather live from New York City. The deputy CIO of Franklin Templeton Investments joins the show. That should be fun. He's going to join us here in the tower. And then later, and Akash. Shout out to Trezor. Use code Rollup10 to get a Trezor at trezor.io, Rob. Which one are you most excited about, man?
Look, I think Lighter, Hyperliquid are both the two leaders in the perps game, and so I'm excited to talk about this dynamic and the power law of perps with the Lighter founders. Akash as well was one of my favorite appearances from NearCon. I don't think we got a word in edgewise with Greg, and he was just telling us about, how he has GPUs powering his entire home and local LLM models. So I'm pretty excited to get a catch up from Greg. And then, look, I'm gonna, let you and Max have just a time talking about tokenization. I'm pretty curious as to how they're going to be tokenizing more of their funds.
These guys are giga bullish.
I mean, Franklin Templeton was all about, hey, we want access to this on-chain net new demand, like these retail traders that are, on-chain. I think I mentioned something yesterday about, look, these guys are used to like triple-digit yield farms on-chain. Yeah. Is that the same customer profile that they're targeting? It feels like there might be a disconnect there. And so I'd be curious how he intends on selling to an on-chain audience when it feels like there is quite a bit of differences in those customer profiles, but plenty to be excited about, man. It should be a really good show to wrap up the week.
Happy Friday. Happy Friday. All right, guys, let's get into the markets and the weather. Before we do, let me tell you about our partner at Frax, infrastructure for the future of digital money, open, stable, borderless. For more information, start using the future of digital money today. Visit frax.finance. Ladies and gentlemen, it has gotten a little bit warmer here in New York. It's 51, feels like 48. Sunny day out there today. I'm sure it's like 75 to 85 in Florida over there, Rob.
Certainly is. You got that right. It is warm and breezy in Florida.
Yeah, it's looking like a bit of a spring day today, I would say, here in New York. Feeling good. No rain, sunny all week. Obviously, we've been in the tower cooking, but did get some time to go outdoors a little bit, hit a park, and go for a nice walk. So, yeah, today's weather segment is powered by Relay, relay.link for all of your cross-chain swap needs. Let's move into the markets, Rob. I think this is what people want to hear about, Matt.
I'm excited where we can get some more assets on, because I want to see what World Liberty Finance is doing. I want to see what some of these other assets like Tau are doing.
It's green, baby. It's green.
What we've got here is everything is green. Bitcoin up, ETH up, Link up, Near up. I mean, did you call bottom yesterday? Is that what happened?
I did tweet that I think the crypto winter
you didn't just tweet. You you had a rant on the heels of CL207, our local tank maxi.
Yes.
Our cat friend with a tank pressing the green button.
Yes.
And this was the spur of the bottom calling.
Yes. I mean, look, he said bye, the big green button. And I mean, what else, what else more can you ask of a lovely cat friend like CL? So look, whether we're bottomed or not, the momentum's coming back. I'm still just kind of waiting. And there's a lot of beach balls in the bear markets. And so the beach ball that I'm currently underwater in is Tau. If you guys watched the last couple episodes with the Tau investment companies, they were very bullish on this company, SN3, Templar, thing rug pulled kind of. So we're going to talk more about that. Bitcoin 72, ETH 2230, Sol 85, near at 1.37, looking very strong. Chainlink at over 9. I think that $9 level is like the level where the Link Marine Army gonna is holding down. And if it goes under that, yeah. So shout out to Zama powering our privacy encrypted transactions on chain. Rob, an amazing partner. Privacy is very important. Zcash is ripping. I imagine Zama could be a part of a privacy trend shift. We shall see.
Let's see what the Zama token is. I think it'd be worthwhile. Just take a little trip around the horn. Ooh, Zama up 10% today.
Yeah, it makes sense. It's a privacy run. I'm telling you, privacy is on right now. I actually had Roman Storm comment on one of my posts today. He was like, I tried, with regards to privacy being very important to the industry, the most important thing since the inception of smart contracts. And he said, I tried. I said, thank you, man.
Out of custody. So I'm glad that he is on Twitter.
That's good.
Well, yeah, I mean, there was a whole, there was a lot of donations made, a whole legal case that I believe he won. So that was a good day for DeFi. Zama up 22% in the last month. I think you're right about Zama being part of this privacy
it's the
trade.
Privacy meta.
Zcash and Monero also doing pretty well.
Zcash is going insane.
Yeah, I bought the top on Zcash, and
oh my gosh,
I think I'm still holding.
Yo, come on. What do we got for Rob?
I think your Tau position, which is also my Tau position, and my Zcash position are they're just eking out your uranium position.
Oh my gosh,
how's uranium?
How's uranium sitting pretty at 51, barely up, barely down. Yeah, we shall see. Not full panic mode. Macro is not full risk on yet. Seems to be kind of an unstable whiplash middle ground. Still, I think the market's kind of questioning higher for longer macro policies. This energy-driven inflation that is happening. I think oil prices still remain quite elevated for the average investor's risk appetite. Crypto, on the other hand, tends to kind of lead the markets. And when I see crypto kind of bouncing like it is, it tells me that whatever is happening in the macro has kind of subsided enough to allow crypto to kind of have a more secular run and to have secular pumps. And so, yeah, let's get into the news today, guys. Before we do, let me tell you very, very quickly about our AI partner, Near, the blockchain designed for AI native applications and autonomous agents. Start developing today at near.org, near.com, near.ai. Guys, we've had a big push from Brian Armstrong. So Coinbase CEO Brian Armstrong says it's time to pass the Crypto Clarity Act, saying that he's grateful for all the bipartisan work from the entire state of Washington. That's what it seems like as of late. And over the past couple months, make this a strong bill. The core goal is to get a split between the SEC, CFTC. We want to see regulation by enforcement come to an end. We want to see a very clear market structure for this industry. Guys, if you are not on Team Brian here, I don't know what to tell you. This guy is going in and trying everything that he can for his public company's interest, Coinbase, for his private interest with USDC, Circle, and everything that is, kind of part of that web. The guy's going to DC, pushing all of the senators, the Treasury Secretary, trying to get this done for us. Guys, I think we're closer than ever. I've remained strong. Q2 is when clarity will pass. Put it down. Q2, clarity will pass. You heard it here first. Rob, do you agree or disagree on it?
I am going to choose Look, I do think that if it passes, it's going to pass in Q2. This is what we've been talking about. I also think that the largest obstruction to this bill was Brian. Brian was saying that he was not going to support this in the previous form. It seems like that has changed. Now Brian is saying, it's pretty interesting. I mean, Brian didn't want the yield issue to go through, right? We saw that there was this resolution which effectively said the banks won and that we weren't going to be able to pay yield on stable coins. That was protected the bank's interest so that there wasn't this capital flight. And so that's exactly what Brian must have been looking for, because now he comes out in support of this. So it feels like the crypto crowd is united once again. Polymarket hasn't changed. Still 57% that Clarity Act is signed into law in 2026. So that's what I put the odds at. 57%.
Yep. All right, guys, that is Clarity. That's where we're at. I think that is something that the entire industry is ready to push forward on. And yeah, looking forward to seeing where this lands. Let's keep it rolling here. NYSE partners with Securitize on tokenized securities. Guys, so if you were part of the DAS coverage, this news dropped, then wanted to just kind of resurface it. Basically, the NYSE has signed an MOU with Securitize to be the first digital transfer agent on the NYSE's upcoming blockchain-based platform, enabling the issuance of tokenized stocks and ETFs. Guys, Rob's right. The NYSE is the next L1 trade. There is no other crypto native L1 trade coming, guys. It is the NYSE is going to take their entire book of clients, of infrastructure, of distribution. They're going to launch a blockchain. It is going to compete directly with all of your favorite chains, probably in a more KYC permissioned Canton network style, which, side note, Canton just became the official partner of CFC St. Moritz. They pulled it out of Algorand. So Canton is they're being very precise with their conference marketing budget. I talked to my quant further about the reasoning behind his prediction about why Canton might outperform Hyperliquid. And he said, you want to own the thing that everybody hates. And so, yeah, guys, I mean, look, that's Securitize NYSE, man.
That's why I own ETH.
Well, not sure everyone hates ETH the way that they do Canton.
I don't know. People don't like ETH these days. You heard it from Logan. I was talking to Buy Quant this morning, and he ridiculed me for buying ETH.
Yeah, I mean, I cannot believe you would own ETH over Hype right now. That doesn't make any sense to me.
I own Hype as well. So
No, but like in any portfolio allocation, I would never own ETH over Hype in this current moment.
I own both ETH and Hype, so I think that point is a non-starter.
Okay, but what I'm saying is that I wouldn't own ETH in the first place if there was a chance to own Hype.
You can own both. You don't have to own one and not the other. You don't have to put limits on yourself like that, Andy. You can own both. There's different value propositions. There's different investment theses. I think these
are
actually quite complementary. I invest in both the app layer as well as the infrastructure. And I think ETH is the settlement layer because we're going to see more of these alternative trading systems. That is what New York Stock Exchange calls it. They're not calling it an L1 or an L2 or whatever else they want to call it. They're calling it an alternative trading system because that is what the regulators call it. That is what New York Stock Exchange is launching. And I think NASDAQ is going to launch their own alternative trading system. I think we're going to have several of these alternative trading systems because ultimately they're all going to want to build their own. They're not going to want to deploy their indices or their equities on someone else's alternative system. But the main value proposition of on-chain of... Well, you said it. I didn't say it. I was going to, the main value proposition here is to connect disparate ledgers. Do you think NASDAQ and New York Stock Exchange are going to connect their ledgers on Canton?
Canton and Hype are both going to outperform ETH for the entire year.
You want to make a friendly bet?
I mean, I have with my own money. How else do you put it?
I mean,
all right, guys, let's move on from the NYSE here.
Three. The point is that these alternative trading systems are going to need a settlement layer to interact with one another. I think ETH is that settlement layer.
Yes. Okay. Ethereum, the blockchain, might be that settlement layer, but ETH, the asset, has zero representation of the value on that settlement layer.
Let's talk about a quantum resistant asset. Let's move on. Dude. Crypto Haze is putting his entire stake against Zcash. This is private and quantum secure money, which I think is extremely important because what we see happening is this entire global order becoming reset. Here's Arthur Hayes in his tank top talking to Pompliano in his suit. And on one side, you have a very buttoned up digital asset treasury manager. And then on the other side, you have a gazillionaire Chad. I'll let you guys figure out who is who. Arthur is
Let's get some love for Arthur Hayes, man.
Behind Zcash. And I personally love to see it. I think the thesis is still just playing out.
Let's go, Arthur.
It's completely anonymous. I think just is how it is. Now, if you want to have complete anonymity, especially in an age of big tech, big government, and AI that can easily de-anonymize transactions and put a physical person to an address, then you want something like Zcash. Now, I particularly believe that Zcash is the best manifestation of this, as zero knowledge proofs plus Bitcoin. But other people have other opinions. There's Monero, there's other different type of privacy assets. But we're all trying to do the same thing, which is if you want complete privacy, and there's good and there's bad things about that, here is a protocol for you. And I think we're going to, that desire to have completely private digital money is going to increase over time as the ways in which it's easy to de-anonymize Bitcoin. It's not going to be so easy and so trivial that people, oh, well, I actually wanted that to be a private transaction for whatever reason. No judgment. Well, then here's Zcash for you. Use this instead, right? And so that's why I think having both makes sense. And the price of Zcash is going to go up a lot to reflect this desire to have privacy over the internet.
Yeah, I agree. I think Zcash could go on a Bitcoin 2015 style run. Like, I could see the thing trade $2,000 to $3,000. And I can see it go quickly. It makes sense. Like, it just makes sense. You want a inflation resistant hard asset based on proof of work that is private. I mean, who doesn't want that? Even if you're just an American person thinking about how you can save more money from Uncle Sam, it just makes sense. If you're a person who is in a jurisdiction who doesn't have rights to the money that people in more established countries do, you want to hide your money. If you're doing payments, you want to hide your money. It just makes sense, man. Arthur's right, man. Zcash is going to go on a Jenny run. Straight up a generational run. It already is kind of starting, it seems. I wouldn't be surprised if Zcash beats the entire market to new highs that were set in Q4 the last cycle. It just makes sense. Anybody can understand the need for private money, and it just makes sense, Rob.
I don't have much more to add. I own some Zcash. Like I said, I bought it at the highs. I feel like I should have just doubled down for the reasons that you're explaining.
Yeah, you probably should have.
But I feel cozy in Zcash.
Nice.
I think that there is an investment thesis for it, and we're seeing it play out. I think Zcash is probably more akin to the chaos hedge value proposition that we like to attribute to Bitcoin. As Bitcoin gets more institutionalized, Zcash, I think, is fitting more and more into that mold. So yeah, I tend to agree.
I like it.
I think it's going to do quite well.
I mean, look,
especially
rising surveillance,
the chaos,
AI, big tech, governments cracking down, privacy as a major theme. It's kind of just all coming together. I mean, I think the European Union just put out something that was saying like, we're going to limit like, or we're gonna start to like restrict ChatGPT usage, for example. There's just all this like surveillance, constriction things trend that is happening, and yeah, I mean, you got to fight back against that. Let's move on into our friends at Etherealize, who, from Mark Andreessen, obviously A16Z, I think AI is the killer crypto app. It's now obvious that AI agents are going to need money. It's already happening.
Yeah, so
Wow.
Mark says, my friends who are the most aggressive users of OpenClaw have given their claws bank accounts and credit cards. And not only
Yeah.
have they done it, but it's also obvious that they needed to do it. It's just completely obvious. The number of people who have done it today is probably 5,000 or something, but it will grow. That's how these things start. So
Yeah.
obviously these things need money. They've given them bank accounts and credit cards, but why crypto? Let's watch the video to find out.
No, now I think it's going to happen for sure.
Yeah.
And there's two reasons it's going to happen for sure. One is we actually have internet native money now in the form of stable coins and crypto. And this is, I think this is the grand unification basically of AI and crypto is what's about to happen now. I think AI is the crypto killer app, I think is where this is really going to come out. And then the other is I think it's now obvious. It's like, obviously AI agents are going to need money. And it's already happening, right? If you've got a claw and you want it to buy things for you, you have to give it money in some form.
I would say the adoption is probably like 0.1%. If that,
I love Mark.
Oh, today, yeah.
Guy's so smart.
Think forward. Like, where is it going?
Look at him.
Forward thinking.
The ultimate principle of everything and everything that I think we do is it's the William Gibson quote, which is the future is already here. It just isn't distributed. It isn't distributed yet. My friends who are the most aggressive users of OpenClaw just like have given their claws bank accounts and credit cards. And not only have they done it, it's obvious that they needed to do it because it's obvious that they needed to be able to spend money on their behalf.
Yeah.
It's just completely obvious. And again, like, so the number of people who have done that today, to your point, is like, I don't know, probably 5,000 or something.
Yeah.
But
It'll grow.
that's how these things start.
Yeah. I mean, look, giving your OpenClaw credit card and bank account is kind of insane. Maybe this is part of your Ethereum thesis that AI will need Ethereum for low risk DeFi.
I didn't think it was contrarian to be an Ethereum bull, but here I go. I mean, AI agents are going to go where the primary, they need low risk DeFi. I think Etherealize makes that point here. You've got Justin Drake co-authoring a quantum paper for Google. And then you've got the largest deployment of stable coins and the shelling point of settlement for tokenized assets.
Yep. Yeah.
I think it's pretty clear. I don't know if they're going to win all of these at the same time, but I think they're in the lead on 4 of the most important pillars of where this economy is going. And so that's where we're at. I mean, you have low risk DeFi for AI agents. You have the lion's share of stable coins, and then you've got the shelling point of tokenized assets. I think that is those are 3 of the most important pillars of the on-chain economy, where we're at right now. And then you've got something that is going to be very important in 3 to 5 years, according to Justin Drake and the Google authors. And so what we have is a lead for Ethereum, and how that translates to ETH, the asset, that's where I think it's maybe a little bit less clear. But you have to think, if you have a very valuable piece of infrastructure and it's supporting millions and millions, if not more, then we're going to have quite a valuable piece here, and then we'll figure out how to monetize that. So let's keep going. I think Andy's setting up our first guest in the tower. So why don't we kick over to World Liberty Fi? All right. So obviously what is happening here is so we've got World Liberty Fi depositing quite a bit of money in their own protocol, as well as Dolomite. World Liberty Fi is, of course, the volatile currency governance token of World Liberty Finance. They've deposited this quite a bit of money. I think upwards of $100 million, maybe 500 million actually. We'll fact check that. And they've borrowed USDC against their WLFI token. We've seen this happen before. We've seen how you have some sort of volatile collateral asset and some sort of stable debt. And then once there's a run on the volatile collateral, that goes down and they're not able to pay back the margin or add more collateral to service this debt. This happened with Terra Luna. This happened with FTX and their FTT token. And so World Liberty Finance addressed this. They said, let's talk about the FUD, what's actually happening. They said, if the collateral goes down and their loan is at risk of liquidation, they would simply add more collateral. Well, there was exactly a situation where that happened, in which case Do Kwon said, steady lads, deploying more capital. We all saw how that turned out. So I think the Trump family might benefit from a lesson in old crypto lore here, because you can't just simply add more collateral if your collateral is a volatile governance token. If they have other collateral, Bitcoin, ETH, stable coins, they want to add that to supplement their loan, that could work. But I think we're going to need a bit more insight into the balance sheet of World Liberty Finance to understand how exactly they're going to service this loan. It is important that this project just doesn't go to zero, or else there is major political backlash for the industry as a whole if this project does go down. So, guys, we're going to take a quick standby break. Andy's getting our first guest, the Franklin Templeton Deputy Chief Investment Officer. So let's do a quick standby, and then Andy's going to be coming at you with Max from Franklin Templeton.
Alrighty, guys, welcome back to the Tokenization Tower. We're with Max here of Franklin Templeton Investment Solutions, the Deputy CIO. Max, good to have you, man.
Thanks for having me here.
Welcome to the Empire State Building.
Yeah.
Welcome to the Nest.
Nice.
I heard you had a good interview this morning at the NYSE.
That's right, yep.
Nice.
Going from the annals of TradFi straight to the hallowed nest of DeFi.
So you are the Deputy Chief Investment Officer of one of the largest asset managers in the space. You've been doing this for 22 years, I think I saw on your LinkedIn.
That's right.
Big LinkedIn guy, huh?
Yep.
Nice. Well, wanted to kind of bring you here to speak about this convergence, really, between what we're seeing in the digital asset space and with traditional finance, and just kind of how you're thinking about this and what this looks like from your firm's perspective, as well as yours on the personal side. Before we get into that, any disclosures, disclaimers, anything that you would like to say about your role, or just, yeah?
Sure, just general disclosures. Don't take anything I say as anything other than my personal opinion, and it's not an investment recommendation. Exercise caution when investing in things that trade at a high volatility.
Like Bitcoin. All right. So one of the talks of the town here in the digital asset space has been this rise of 24/7 trading, right? This kind of war, this oil spike, these things that were happening on the weekend drew a lot of attention to a little exchange called Hyperliquid. The Wall Street Journal covered it. A lot of these kind of institutional focused mainstream news cover this concept of like oil futures are now being traded on this little exchange called Hyperliquid. What is your take on the rise of 24/7 tokenized commodities trading, equities trading? How do you kind of see this playing out? What's your thoughts here, just high level, and then we can kind of get into some of the nuance.
Sure, yeah. So high level. We used to have this phrase coined here in New York City that money never sleeps, and that wasn't actually true. Money took naps and it slept on the weekends, and it doesn't anymore, right? That's actually the real 24/7 market. Why did we start the war on a Saturday?
Yeah.
Markets were closed.
Yeah.
right?
Trump does that a lot.
Like that's the reality, right? Like it's not a coincidence when this operation kicked off. You couldn't launch Epic Fury when oil futures were actually trading in the pits. And speaking of that, we don't really have pit trading anymore. So like you mentioned, I've been around this industry for a while. I've gone from seeing like real, like actual traders on, say, the IC and in Chicago moving markets to all of that being electronic. This is just the next evolution of that. And it makes perfect sense because things happen 24/7. So as an investor in TradFi assets now, like commodities, like equities, like fixed income, what do I do when something like Epic Fury kicks off? I look at the DeFi space. I look at futures on Hyperliquid. I look at what's going on with the crypto market. I look at other tokenized venues, and I look at prediction markets like Kalshi and Poly to see what the actual sentiment is. Now, what I think is going to start happening is you're going to see more and more firms move into that 24/7 market and offer their products there, because otherwise they're just missing out on that additional opportunity for capital.
Yeah. Yeah. And I mean, there's been some resistance and pushback from firms due to the infrastructural changes required to kind of shift into a 24/7 world, whether it be on the market making side, on the kind of reserve management side, or just kind of a combination of all these factors. What do you anticipate to be the logical transition to get the NYSE, the NASDAQ, and the large exchanges of the world trading 24/7? Obviously, in the metals market and in oil and in some commodities, it's closer to like 24/5 with a little hour break there. What do you anticipate to be that progression?
So hopefully this doesn't get my NYC admission pulled, but it's a bit of a blockbuster Netflix moment, right? Like we actually don't need the NYC to do this. This is going to happen regardless. They should be moving to offering tokenized equities. The market is going to go 24/7. The providers of liquidity for that are going to be winners. And it's really going to be up to how we can orchestrate successful multi-venue execution. We've been doing a lot of work at Franklin with things like our Benji platform that can offer cross blockchain transfers. And I think that's going to be really important. Like I should be able to trade what I want, when I want, how I want, full stop. The technology for that exists. It is not dependent on really a massive entity with physical space anymore, right? So I think once we've established that, it's just a question of who's going to be the dominant player providing liquidity and matching buyers and sellers for that. And I think the answer is just going to be more than one. The technology exists with blockchain, and even people who are never going to trade crypto as specifically an asset class will still be using blockchain technology to trade whatever it is that they're trading. Now, we have one bit here that does need to adjust, and that's regulation. But we've seen just from what happened in March with the SEC, CFTC joint statement, we're seeing more and more moves towards a more sensible way to govern crypto and on-chain transactions. Once that's really established, institutional adoption comes in, and then it just becomes the default, right? Like we all, like as much as I liked taking some time off, the reality is you can't anymore anyways. I'd rather be able to trade things as they happen.
Yeah. So do you think that there's going to be regulatory issues with some of these perps exchanges on chain? Right.
I think there will be. I think there's going to be a lot of questions, and again, there are multiple ways. If you're an exchange to address that, you can either work with the regulators, you can kind of figure out how to get around the regulators in a different jurisdiction, or you can sit on your hands. And I think the ones who are going to do the best are the exchanges that really take a regulatory first mentality. Even if they don't agree with the regulations, they follow them. They work with the largest regulatory bodies around the world. That's another key part of it. It's not just the SEC and the CFTC which you need to get on board. You have to work with other broader regulatory bodies in Europe and in Asia. But those who take the effort, time, and money to do that are likely going to be the winners.
Yeah. So you have a lot of experience in kind of like multi-asset, multi-venue alpha generating strategies, right? Like that's been your bread and butter for 20 years. You're sitting here in a lovely pink shirt, great suit. Like this is your expertise. I'm curious if you're seeing a opportunity to generate yield and alpha from like off-chain venue pricing and on-chain venue pricing for assets like a tokenized oil or tokenized gold or tokenized equity, and kind of how you anticipate those strategies to really come to fruition. In crypto specifically, we had a kind of a basis trade for the last 2-3 years in the bull, right? You could generate yield on like effectively a stable coin or a delta neutral strategy by doing interesting hedging on perps, which is obviously a novel instrument in crypto. How do you anticipate kind of this alpha generating strategies with off-chain venues and on-chain venues as it pertains to more kind of like TradFi assets?
Sure, it's a great question. So before I came to Franklin, I ran a much smaller digital asset hedge fund. And this was back like pre-FTX days. There was a lot of cross-exchange arbitrage you could do. And honestly, like it was easy money. Yeah. Like, I mean, it's always like fun to say that after the fact, but it was like if you were set up as a private vehicle that could trade across any number of exchanges, you really could arb. I mean, not even just like TradFi assets on and off chain, but just like native crypto assets. Yeah. And then more bigger players came in and that went away. And now we're seeing this with perps, and it's going to be the same thing. We saw this happen with high frequency trading back in the day, where once they came in, we saw those mini mispricings go away. It's actually a good thing. It generates a more efficient market. We want a more efficient market for digital assets. At least when I say we, I mean us, like firms like Franklin that want to be able to offer digital asset products to the largest institutions, because we want them to know that the market is deep, it's liquid, you're not going to have some mispricing or some major risk event because of the underlying mechanics. Like that's why people get scared. So I think, yes, there's still some ARB there. That ARB is going to go away. Like, and by the way, look, for anyone watching this who's thinking about launching a strategy, my view is always, if you see alpha, you should take advantage of it, because all alpha decays over time. That's true of every asset class I've ever traded. That's why as an investor, we're always looking at new ways of generating it. But if there's an ARB, take it, because it's not going to be there for very long. Yeah.
And is it just as simple as the pricing, the arbitrage opportunity on pricing from an asset on chain or on a crypto venue versus a TradFi venue? Is that just as simple as it is?
It can be that simple. And sometimes it's, different venues, different crypto venues can actually have different pricing. And it's really just a question of how quickly can you create a delta neutral position so that you're not taking on undue risk. Or, in some more complex ARBs, you are taking on some amount of risk. And if, and again, like this is where, again, I'd stress, this is not investment advice in any way, shape or form, but there are strategies that purposely take on some amount of risk, knowing that in grand total, these small positions add up to, picking up the proverbial pennies in front of a steamroller, and, you're picking them up quick enough with more advanced systematic methods. But that steamroller is going to start moving a lot faster. And again, like that's where that alpha decays and the market becomes a lot more liquid.
Yeah. And last thing on this front is the transition to 24/7 something that a lot of the, all the market makers in digital assets have been used to for 5-10 years? Is that a source of kind of alpha still, given that let's say the traditional firms aren't used to having to manage these markets 24/7 in that same way, or is that just not the right way to think about it?
I mean, I think it's decaying rapidly. Okay. So I really wouldn't focus.
Citadel's in these large firms are
exactly. Yeah. Citadel, Susquehanna. I mean, they're in there, and whatever's left, it's going to be gone very, very soon, to the extent that there even is anything in there. I mean, I can tell you it's not something, I'm actively looking at.
Yeah. Okay. You guys just announced a partnership. I actually had your colleague Sandy call on the show. She's great. She's a ton of fun. And we talked about this idea of tokenizing Franklin Templeton's ETF products, bringing them on-chain via Ondo, get a lot of distribution via their on-chain kind of set of customers, users, wallets. There's, probably about 10 million active wallets, actually active on-chain. And one discrepancy that I'm trying to wrap my head around is a lot of us who have been DeFi native and have done our portfolio management on-chain for 5-8 years, we've been very used to honestly operating like it's a minefield. It's smart contract risk. It's high velocity, low market cap tokens. It's aggressive leverage. It's borrowing on chain. It's collateralizing assets. It's holding things in self custody. It's a whole operation, right? And the products that a firm like Franklin Templeton offers are much more risk-adjusted, risk-averse products. So I'm just curious, in this kind of like tokenization thesis, who do firms like Franklin Templeton actually anticipate the user or the buyer of something like a tokenized treasury or a gold ETF or a commodity ETF? Like, do you anticipate that the same users used to high triple digit APY, aggressive short-term instant liquidity protocols are going to be the same buyers of a 4% tokenized, treasury account?
So I think this is where you're going to see actually this become a bit of a two-way on-ramp. So on the one hand, it's going to be the traditional buyers of those ETFs who actually want to trade them 24/7, and they use this as their on-ramp onto the broader DeFi space. And then once they're trading these ETFs, they're like, okay, what else can I trade in here? And they see some of the more DeFi native products. Something that we'll be looking at is products for that space specifically, in addition to tokenizing our existing funds. But then you also got the other side of it, which is, like the people who are used to the massive returns, but also the massive volatility of those DeFi products, actually saying, maybe there's something to this diversification idea, and I do need some amount of assets that are TradFi, but I don't want to move to a TradFi rail to own that. And that's another part of this where I think we're going to see a future state where it really is about proper risk-adjusted returns. And by the way, leverage is something that works, for any number of products. And so you could, of course, again, not investment advice, but you could lever an ETF. So even a treasury can be quite palatable to a more crypto native client if it's levered enough. But the broader, much more important point is there's going to be a realization, and I think it's actually up to folks like myself who straddle the two worlds to explain to both sides. On the one hand, why do crypto native people need to own some TradFi assets, whether it's commodities, stocks, or even TradFi currencies, and then explain to the more traditional investment crowd why they may want to move on chain, both to trade existing instruments that have been tokenized, so the whole RWA market, and then also some products that are done in a risk managed way for them that are DeFi native. I think that's going to be the great coming together, and we're going to get to this point where we don't think of TradFi and DeFi, it's just going to be Fi. That's the future is going to be a single financial market that I believe is going to be predominantly on-chain and 24/7.
Yeah. So it's a two-way thing here, right? It's not just looking for distribution in these existing users. It's actually bringing some of those other traditional investors on chain who want to have access 24/7, and then giving other optionality to the on-chain existing set of users.
Exactly.
Yeah. And you know what? People say that this may not get traction or it may not get picked up, but the reality is people who are on chain, they just want to stay on chain. The process of pulling money from the on-chain world and the crypto world into your bank has been a lot easier as of the last couple of years. But for a while, it was a bit of a nuisance. And that whole process is to people who've lived and die on chain, they just want to keep their assets on chain. And then a time for the last 6 months or so, if you could just get access to safer yield generating products in kind of a crypto cold front, I think there'll probably be a lot of appeal there.
No, there is. And I feel like that's part of our view. Look, we're one of the largest asset managers in the world with over $1.7 trillion under management. We want to be bigger. And we think the way we get bigger, one of the ways is going after folks who are on-chain natives. We want to offer our products to them. We believe there's value in our products. Some of them are going to need to be modified and more than just putting them purely on-chain. But we feel like that is a market that's deserving of being served by an institutional grade asset manager.
Yeah. So I'm curious from the firm's kind of view on how the state of blockchains is going to kind of evolve, right? So I think the NYSE is getting ready to at least have a blockchain-based platform, is what they're calling it. Perhaps like an ATS, or like a layer one or a set of nodes, right? That is the NYSEs. How do you anticipate the kind of evolution of blockchains as trading venues with the public set versus these more kind of institutional, perhaps more permissioned set? And even Canton is like stirring up the pot right now as a kind of first interpretation of what this looks like. How does this gonna play out from your view, and what do you see like the specific use cases for these different types of execution environments?
Sure. No, I mean, I think the short answer here is we don't know yet, and we're going to be figuring it out. And look, that's been the thing that probably scares most people once they get past the initial, like, okay, I'm going to be in crypto, they'll realize how complex it is. And it's almost like, when I see people who've gone from a TradFi world and they kind of get over like, I'm not investing in meme coins, like, yeah, but there's a lot more than Dogecoin to crypto. Then they go like, holy crap, it's actually incredibly sophisticated and complex. There's a reason why a lot of people leading these projects had very extensive TradFi derivatives background, right? So we're figuring it out. I think there are going to be private chains which are required by regulators. We need to figure out how to do KYC with institutional clients and other clients. And then we need public change for broader, faster transactions. So there's probably not going to be a single solution. What we're going to need is a way to move between change in a way that is as frictionless as possible. I think that's where this is heading. But again, really hard to have an opinion when we're this early. The smart thing to do and what we're trying to do is partner with who we see as leaders and being really nimble.
So no plans for a Franklin Templeton blockchain then?
Not to my knowledge.
Got it. Because it just kind of begs the point of, we had a lot of these institutional kind of POCs happen over the last 5 years, kind of getting their toes in, but now it's like very firmly in. And I actually had your colleague Sandy on. She was telling me that the 60-40 portfolio is done, that this is not the right way to think about how to invest now. Had Jeff Park, the former CIO of ProCap, kind of say the same thing. And so it seems like the tides are turning to a different way of thinking about fundamentally structuring a portfolio in 2026.
Absolutely. I mean, first of all, 60-40 has been, bread and butter for asset allocators for a really long time, but it hasn't really, it only has one thing going for it. It's very simple, right? And it's sort of, if we take a mass average of investors, it kind of is like that midpoint of risk where it's predominantly equity risk, but you got a bit of diversification from fixed income. The reality is most investors have never thought like that. And we, even without getting into any of the digital asset considerations, we've moved into things like goals optimized investing, where we actually, for retail investors, look at what their goals are, which could be, I want to send my kids to school. I want to buy a better house. I'd love to buy a sports car. Okay, well, those are all different goals. Maybe sending your kids to school is a high priority goal, house, that'd be really nice. And, the sports car is a desire. For me personally, it might be reversed, but, that's kind of the point. And so then we build a portfolio that kind of matches those goals to different assets that have the appropriate risk and return stream. So that's the real concept, right? It's about the denominator, which is risk, and the numerator, which is return. And then diversification comes in terms of how those return and risk streams of each underlying assets are correlated. So if we can construct a portfolio that actually matches that appropriately to an investor's goals, that's the solution. And that actually works for an institutional player, like the largest pensions that have liabilities they need to offset against assets that are going to produce income, or for a retail investor who's just trying to get by. The same underlying concept is the same. What technology allows us to do is bring that fire like Prometheus down to the retail investor. And then what blockchain allows us to do is to make it into something that's much more portable, much easier to deploy. And then we add in the additional benefit of digital assets into it. And that just becomes another tool in our toolbox, the same way as commodities, as equities, as fixed income to build the right portfolio.
Yeah. And is the digital assets allocation still around that 1% to 2%?
I actually think that that's absolutely the wrong way to think about it.
Okay.
The right digital asset allocation is not some fixed number because, for, like a G-Gen like me, maybe it's 10% because I'm comfortable with the amount of risk. And I've got other liquid investments that are much lower risk. And, I'm comfortable with having the liquid portion of my portfolio gyrate around a lot more. For my mother, it may be 0% because she wants just super steady income. But, could I put her into a stable coin that generates yield? Probably, yeah. And she would be very happy with that. Yeah. So I think the bottom line is, what is the goal? From the goal, you derive a benchmark, which is your bogey. As an investor, that is what I'm trying to exceed performance of, that benchmark. And that benchmark is going to vary dramatically from investor to investor. And that benchmark is going to have risk and it's going to have return expectation. And the general rule is I don't want to have any single asset class take more than a fifth of risk. So if I'm thinking about digital assets more broadly, it's how much digital asset represents about a fifth of risk. For a portfolio that's all equities, it could be, 6-7%. For a portfolio that's mostly fixed income, it may be 1% or less. But the point is, we got to think beyond that traditional 60-40 anchored mindset.
Yeah. Okay. Then kind of zooming into the space itself of the digital assets, you've got kind of this common frame of thought, Bitcoin being like this digital gold. Ethereum's earned its place as this kind of like technology layer. And then you've got all the rest. At least that's kind of how I am thinking about it from the institutional allocator perspective. And there's a ongoing trend right now, and it's been going on for a while. I actually called it something silly, the revenue meta, which is like we are now in a period where revenue matters in terms of DeFi protocols. And I think I called this out about a year and a half ago, and we were still in this very like narrative driven crypto landscape, but it's very, very, very drastically changed now. And so there's a cohort of leading DeFi protocols that are actually generating significant amount of revenue, allocating that back to their token in a form of a programmable buyback or some sort of share of that revenue. Obviously, I think the market structure bill and clarity will help to really kind of put this into stone. And so like the pendulum of investing in the space, inside the space, has shifted far from like the network effect, L1, L2 kind of blockchain trade to like who's making money or who is like very, very hard, like, hard store of value. And so there's this cohort that I mentioned, and I'm just curious, like within the space, what are you anticipating as far as dispersion of outperformance going forward?
Sure. I think that's one of the things that is really important about this space. Because, like whenever I talk to, like if I'm on a TradFi show, like if I'm on CNBC or Bloomberg and we're talking about crypto in the context of assets, it's almost always just Bitcoin and maybe Ethereum, like you said. But it's not a monolith. And I think we need to look at other tokens. We need to look at utility tokens, at tokens that are actually backed by RWAs. We need to look at gaming and DeFi tokens, and they all are actually kind of like different sectors in the stock market, right? So no one would bring me on to talk about stocks and say, okay, what's your opinion on equities, and really mean just what's your opinion on the Max 7, right? They would generally want to know about my views on utilities, industrials, and healthcare, et cetera. So it's kind of the same thing. Like just because the Max 7 is so dominant, it's not the entirety of the equity market. Just because Bitcoin and Ethereum are so dominant, they're not the entirety of the digital asset market. So I think as we see more institutions come in and as we see more active players come in, that's just what you just described is just one way to value those other tokens. Yeah. We've been developing other ways, and they kind of depend based on what the token is. So if we're looking at a DeFi token, it's what's the volume of transactions. If we're looking at a gaming token, what are the players are we seeing, like those rewards actually getting sold in a secondary market on chain, right? Like if we're looking at a technology platform, who is making commits on GitHub that are backed by it? Are they the people making those commits like respectable in the space? Like we're building these valuation methods that are differentiated, but ultimately not too different from how we would look at evaluating any business to determine if it has intrinsic value or not. And then if our view of intrinsic value is different from what the market is pricing, then that makes it, a good long or short position.
Yeah. Okay. So then you guys are developing then a view specifically for the sectors of the market.
Correct.
And are you guys like overemphasizing or emphasizing strongly on purely just revenue?
So I wouldn't say purely just revenue, but it is a big component. I mean, I think you do need to look at I would say really, especially where we are right now, what's the second derivative of revenue? Like is the revenue, and by the way, same thing if I look at most tech firms, right?
Yeah.
Like, are we seeing an acceleration in revenue? How is that acceleration map out? Is there like a terminal value where we expect some kind of steady state? Is it more cyclical where we expect like hurdles where like, really strong revenue growth, whatever percentage terms, triple digits, until we get to like a leg down, another leg down, and at a steady state? Those are all really important things to consider. But yes, revenue matters, DAUs matter. All of those things together basically build your valuation framework.
Yeah. And you are still excited about gaming in crypto?
I still am. I mean, maybe
that is a hot take.
Yeah. I mean, I know, and it's been like a lot of people kind of make fun of Decentraland, right? And I think like, okay, fine, Mana, it wasn't everything that it said it would be. But I think what excites me about that is this kind of concept of how I see the evolution of money as a concept for Gen Z and Gen Alpha, which is, it's really like we've gone from like, people like, well, older than me, would say like, I have one job, maybe two jobs. And then like, millennials, we're like, we work at a gig for 5 to 7 years, but we're flexible. And then you kind of have the gig economy that also came about with the younger millennials. I think the newest generation, they're not really looking at things that way. They're looking at money as something that they receive through any number of things. So if they're making money gaming, that's just part of the way they make money. If they're getting income, which for older generations, like, Gen X boomers would be something you think about just kind of in retirement. Like, how do I, now that I have this nest egg, how do I generate enough revenue till I die and leave something to my heirs? So now like, no, income is just something I might be getting an airdrop of income from this cultural asset that I own, where maybe I owned a share of royalties from an artist that I like, and also I got airdrops to go see them at a show. So it's like both a utility that's not pecuniary and a utility that is money. And then, yeah, like you have a job that pays you and gives you health insurance, et cetera. But there's a much more fluid approach to how you make a quote unquote living. And I think that really syncs up very nicely with a smart contract based world. Like, why can't my employment contract be actually a smart contract that also has, a smart contract for my health insurance, for my life insurance that adapts as my habits change? Those are all things that could be done on chain much more efficiently, make it much more portable. And from an asset management perspective, that gets me excited because that's like a whole new way of actually helping people maximize their utility in the world and maximize what they can generate to live the kind of life that they want. So that's why I'm still excited about gaming tokens.
Yeah. So Jamie Dimon came out with something a couple days ago saying that tokenization is going to do kind of a lot in the way of disrupting banks and kind of what banks do. And we're kind of living in this agentic world where intelligence is rapidly accelerating. I know you're excited about this and have done some investments here and thought about this. Are you at all worried about AI coming for asset managers?
I'm not, because I'm building AI that's going to come for asset managers.
See, that's what Jamie was saying, is like banks need to go build tokenized products and blockchains before they are basically, usurped.
Absolutely. And that's the number benefit of not being a bank, right? Like, I mean, yeah, like if you're thinking about it, like I started my career as an investment banker before I started a hedge fund. And like, yeah, all of the work that I did as an investment banking analyst can be done by an off-the-shelf model very quickly. So that means that there's not so much of a need to pay those big banking fees. And then there's a question of like, well, do I really need to do an IPO where I need this whole roadshow and, you know, all the bells and whistles, or can I just do an ICO?
Yeah.
It's another question, right? Is it simplify like the whole concept of adding liquidity to private shares? What are private versus public shares? Well, in a tokenized world, that can become much more fluid. So it's much more easier for me to attract my new employees if they know that they're not tied in to sitting on this paper wealth.
Yeah.
Right? And they can go and like buy that house, that sports car, you know, send their kids to college, whatever. Right? Like that changes things quite a bit. And that actually really isn't great for banks if they still maintain that, you know, white shoe mentality of we are important because we are an institution in and of itself. And that is why you need us. That is how dinosaurs die.
Yeah.
By not looking up and seeing what's coming.
And I think that kind of goes hand in hand with the change of way people are thinking about work that you were just talking about as well. It's all this kind of like progressive evolution. And so then if you're not too kind of worried about the agentic side replacing asset managers, what are you doing to kind of push that forward on your side? How does that actually look?
Sure. I mean, I'll give you one concrete example, just put some meat on it. So we built a agentic analyst. And the reason I wanted to build an agentic analyst is because I saw in my investment committee, like my human analysts weren't disagreeing enough with each other. And I was like, you know, I'm worried about consensus. That's like the worst thing in any investment group is if everyone's sort of like nodding their head.
Yeah.
So I specifically built this agent with my AI team that is really sassy. It's got an attitude. He calls people out on their BS. He can fact check everything near real time. He's got access to everything we've ever said in any of our research meetings. We're working on getting this agent data from sell-side research, from independent research. And so it's able to synthesize all that and actually move the discussion in ways that are much more productive. So now you've got this human agent hybrid investment committee, and it's so much more powerful. And if I want to research something real time, I can just tell my agent like, hey, go research this and then play it back to us.
Yeah.
That is how we're adapting and evolving in this world. And I think what you're going to see going forward is more and more agents in the org chart like that. That is going to fundamentally change the game for investment managers who are at that level. And it's just going to leave other folks behind because I'm getting so much more data at my fingertips. I'm not doing too much secondary or desk research work. I'm doing primary research and I'm synthesizing information, and where I can offload that work to an agent, I'm doing that and it's giving me answers back much faster.
Yeah. And are your analysts worried about your agent obsession?
They're not, because one thing I did is I made sure the entire investment team is upskilled in first of all, just basic concept of coding. They're now getting comfortable writing augmented code themselves, building tools and their own agents that can do more work for them. So actually what gets them excited now is they're not doing what we call the no joy work.
Right.
They're doing the really interesting work. And so it's kind of like you create value from your intrinsic humanity and your creativity, and not from being able to stay up, super late compiling a report on what was said at the IMF conference.
Yeah. Yeah. And so do you think clients would want to interact more with agentic systems in like a client facing manner? How do you anticipate that kind of like relationship part of financial asset management evolving with AI as well?
So prior to Franklin, a couple steps before that, I was an allocator for about 7 years. So I actually invested in firms like Franklin, like JP Morgan and others. But traditionally, when I wanted something, I would have to call my sales rep, explain what I want. They would try their best to understand it, call up a client portfolio manager who would then call the portfolio manager. And then eventually this game of telephone would get back to me and I would be like, that's not quite what I wanted, try again, And so that is not efficient for me.
Yeah.
What is much more efficient is if I ask a question and get an answer back. So actually one of the things that I worked on first when I came to Franklin was building a client-facing system that could answer those questions. Where if one of our institutional clients has a question about, say, how did you build this capital market expectation, which is our 10-year risk and return forecast, or how would you look at this manager, it can actually give an answer. And the clients I've talked to so far are really excited about that because it gives them on-demand answers that are just as good as if they went through about an entire process. But now if they have a question in the middle of the night, or I don't know, we just bombed another country, they can get that answer immediately. So I think clients, especially institutional clients, are going to be really excited about that.
Yeah. On that note, how long do you think it's going to take until we have advisors pitching their clients on ETF products for crypto assets outside of just kind of like Bitcoin, ETH? Like, what's that look like? Because from what I understand, right, like you get this relationship over time, right, with an advisor, you trust them, they slowly start to introduce different ideas to you based on your risk, as you were mentioning. And the whole process of like doing that, getting them educated enough to be able to make a pitch to their client, and then doing the process is quite a process. Where are we at, if you were to say, in like the broad spectrum of that process for crypto assets?
It really depends on the advisory group. Is the short answer. Maybe not like the most, clear answer. And what I've seen is there's advisors who have predominantly less crypto interested demographics that are their investors, and they feel like they don't need to learn anything about crypto. Of course, what is also happening is, and look, not to make a blanket statement, but a lot of those demographics are older. As they pass on and pass their wealth to the younger demographics, those demographics care about digital assets by and large. We've just seen that in the numbers that Gen Z, millennials, even Gen X are much more comfortable with digital assets, hold at least some amount of digital assets. So they're going to ask those questions. We saw the same thing, by the way, with sustainability and other concepts. So those advisors are going to have to learn. And I'm seeing now a lot more questions from our advisory channels of, hey, tell us how to invest in digital assets. How do you integrate this with a traditional portfolio? And so that's where something like the digital asset ETFs, like even the single token ETFs, like what we launched, or multi-token ETFs, they're a really easy on-ramp because you don't have to go on chain. You don't need to set up a wallet. You can just buy it in your brokerage account, so an advisor can easily access it, but at least it gets them thinking about that. And then it starts moving more towards that, advisor really as, I would say, a life coach, where they're helping clients think about money from all parts of their life. And that is where I believe we're going to be as that wealth transfer really continues and we get to a predominantly millennial and younger held wealth base. And then it's going to be similar to institutions and banks and asset managers. You're either going to understand the space and maintain and increase your client base, or you're going to lose it.
Yeah. Max, kind of a personal portfolio thing here. Are you bullish on perps as a category? Are you bullish on Hyperliquid?
So Hyperliquid, I think, has some challenges, and I think what happened in October of last year really demonstrated a concept that I've seen a lot in platform shops like Citadel and Millennium, where when risk goes above a certain point, you just take an executioner's axe to portfolios, right? And so that kind of blunt deleveraging is what caused a lot of the dislocation. We saw the collapsing of the DAT premiums and things like that. So it's hard for me to get super bullish on that just yet. Personally, I think we need a better risk management framework. I think in general, you never want to have a situation where you could see your positions indiscriminately cut. Like, I would never personally be a PM on a platform like that. And I think investors who are playing in that, find out that the name has a dark irony to it, where all of a sudden things were not that liquid and positions were in fact liquidated at a hyper speed pace. So that makes it harder for me to get bullish on that.
Yet, it was worse on centralized exchanges, actually.
It's true. It's true. And I think that's the other part of it, right? Like you really have to know how to trade your within your risk bands. But I think that is something that, you know, we've seen it often enough in TradFi, and I think the DeFi world is kind of getting up to speed on it. But we need to make sure we set up exchanges that have deep enough liquidity that they can manage the risk of these much more volatile products, right? And so then anything that has a harder to capture, harder to analyze return stream, like a perp, becomes a more difficult security to manage within your own book. And then if I'm looking at an exchange level, like at the exchange book, right? And I think that's where, if we minimize those kind of mass deleveraging events, we maximize broader adoption.
Yeah. So there's a tokenization company, Securitize, getting ready to go public sometime with a SPAC. I'm curious if you have any views on the tokenization market and just generally how you guys are thinking about that kind of sector of the market.
So broadly, tokenization, we're you know, really bullish on. I think in terms of RWAs, we've got a lot of private funds within Franklin that, you know, I personally would love to see get a tokenized share class on. I think in general, it's a way, once regulation catches up with the technology, a way to get different investors access to private assets, access to assets that don't currently exist, like cultural assets, like fine art or collectibles. And what we also will need is, to my earlier point, liquidity, right? Like something gets tokenized, that's great. Is it inherently liquid? Like if I'm a big pension and I now have some share of my private equity exposure tokenized, well, it means I can trade it 24/7, but only if someone's willing to take the other side. So I think we're going to need also market makers for tokenized assets to come up. And that's going to be a fundamentally different type of market making than either your traditional equity market making or even your traditional digital asset market making. So that's another area that we're really looking into and trying to figure out how to best serve our clients with that.
I did see so in the recent IPOs, I've seen some tokenized versions launch on chain instantly on the same day on like X stocks, on Solana, and a couple others. So I think that's an interesting vehicle. I agree on the liquidity front on chain for these assets. You need market makers. You probably need an order book. I don't know, like the AMM model is going to be tested hard. There's this new kind of concept of prop AMMs that will, I think, be interesting. I think another area where the market's going to need liquidity is for these big IPOs coming up. You've got SpaceX, OpenAI, and Anthropic amidst a macro war time and a bit of a liquidity crunch. How do you anticipate the market reacts to these $3 trillion IPOs this year? Do you think the market can handle that?
I think the market can if the bankers do their jobs, right? Which I think on this one, they will. So this is actually a good example of where the traditional banking model does have some benefits, right? In a traditional IPO model, right? I think if you were looking at doing something like this on chain right now, like purely on chain, it wouldn't work at that size. I think 3-4 years from now, that may be very different. So it's a great example because these are massive. These are going to be, you know, probably the largest IPOs ever and happening very quickly in succession. And there is demand for it. So finding that demand, corralling that demand, ensuring that it's, you know, listed on at the right time with the right buyers ready, providing that additional liquidity as banks do for their trading desks. Those are all things that need to happen for those to be successful. Could you do that technologically fully on chain? Yes, but you need the bigger players to already be there. That's kind of where we're at. I feel like we're like right at the catalyst point, but not quite there.
So you think the market's going to be able to handle it? Just generally, like the traditional market will be able to handle these IPOs?
I think that their book runners are going to do everything they can to make sure that the market can handle it, because flopping an IPO of that size is not something you are going to come back from. I mean, these are, to your point, some of the most talked about names. There's been so much discussion about when are they going public? How can, you know, everyone from the biggest institutions to retail investors get, you know, their hand on any of these companies? So, yeah, I mean, the bankers are going to be earning their fees on this one.
Max Gokhman, the Deputy Chief Investment Officer at Franklin Templeton Investment Solutions. Thank you for spending some time with us here at the Nest. Enjoy the rest of your day. Ladies and gentlemen, we've got Vlad of Lighter coming up next. We will be right back with him on. Hope you guys enjoyed that one.
How was it?
Alrighty, guys.
Good interview with Franklin Templeton there.
Yeah, man. Max came in and schooled me on the way that these investment managers are thinking about digital assets. Needless to say, guy's bullish and is bullish on perps too, but was a bit bearish on the deleveraging that happened from 1010. Thinking about things in a different way from a unique perspective as well, not in the traditional kind of like asset manager way. So that's interesting. Had a lot to say about tokenized assets coming on chain. We talked a bit about OpenAI, Anthropic, SpaceX as well. Just good conversation all in all. So
incredible.
Yeah.
Well, it's pretty cool. I think, obviously they have quite a few ETFs and exchange products themselves.
Yeah.
And look, the way I think about perps is like, this is a modality that is applicable to several asset classes, ETFs included. Obviously, we've seen the rise of, the RWA asset class on chain, I think also in perps, and really all kinds of digital assets are able to be traded in perps. Makes a ton of sense, provides a whole new dimension for traders to get access. And so pretty stoked. Why don't we bring up Vlad, founder of Lighter?
The CEO and founder of Lighter. We've got Vladimir Novakovski in the building. Let's give him some love, man. Vlad, welcome to the show, man. How are you?
Thanks, Andy. Good to be here.
Happy Friday to you.
Yes, although I feel like in these markets, there's no, every day is kind of the same, so much going on.
It is the end of the crypto winter, Vlad. Good to have you, man. Catch us up, man. What is the latest with Lighter? How has the last couple of months been post-token launch? I know you guys have been shipping a ton. Would love to just get a quick lay of the land as to what's happening over there in the Lighterverse.
Sure. Yeah, you're right. We have been shipping a lot of different things. I think one big initiative that's coming up is the Lighter EVM, which we did kind of a technical deep dive on last week. What that will ultimately allow is kind of any Ethereum developer could launch apps directly on Lighter. So for somebody who's not building something that requires kind of the high throughput of our customized circuits that allow high frequency trading, like let's say you're building a prediction market or you're building a lending platform or bridging, like you can actually just deploy that directly on Lighter, and that would allow you to interact with the liquidity already on Lighter and the same balance sheet. So that's really exciting. That's kind of in DevNet now. The other big things that are coming up are universal cross margin. So kind of like right now, the only collateral you can use for trading perps on Lighter is USDC, and pretty soon we're going to have a whole system there where kind of any starting with the safest kind of ERC assets like ETH, but as well as the LLP, but like that'll really improve capital efficiency, because we're talking about perps, we're talking about spot and tokenized assets. Like I think the bigger picture here is like for all of those to be traded from the same balance sheet and in a capital efficient way. So that's a big initiative for us, as well as a bunch of other things, right? Like adding new assets, improving liquidity, iterating on our mobile app. The team is, this is just still early days for us.
Incredible.
Yeah, man.
Awesome. I'm curious what you're paying most attention to. Obviously, there's so much happening in the markets, but also you mentioned you're shipping tons of features. What are some of the most critical things that you have your eyes on as of late? Are you keeping tabs on macro? Are you heads down building? Do you really? Because from our perspective, it's like, okay, perps as a category does well when there's a lot of volatility in the market. And so are you paying attention to volatility in the market, or are you sort of heads down shipping?
Right. I mean, I think we're paying attention to it to the extent that, there are products that our customers want to trade, and we want to make sure they have the right amount of liquidity to trade them, but also that the risk management engine works well. And, there are no, we don't want another, 10-10 like event, so I mean, I think we are paying attention to volatility, both from the point of view of the opportunity. Obviously there are a lot of folks who want to trade assets like crude oil right now. We're doing, that's not something that 3 months ago was necessarily like the thing that the market expected, but here we are. And so, we have to make sure our customers have the liquidity to do that. At the same time, we want to make sure that everything works in a stable way in terms of funding rates and the risk engine. But we're not. That being said, most of our time is spent focusing on the bigger vision, right? Because this is kind of like ultimately what we want to get to is a place where all of these assets that exist in TradFi are on chain, and you can trade the spot and the perps in a secure and efficient way, and kind of share the balance sheet across them. And that's a longer term vision. It takes time to get there, but right now is like the best time to do that, between all the tech that's available, between kind of institutional, like finally institutions actually get it. Like I think you mentioned previous guests from TradFi was talking about tokenization. I think a lot of folks we're talking to in TradFi really get it now, and regulators get it as well. So this is like the perfect time to be building the future of finance. So that's our main focus. But yeah, if there are specific markets that our customers want to trade, based on what's going on right now, we do pay attention to that.
Yeah. All right, Vlad, let's get into the juicy stuff, man. There is a regulatory question right now surrounding the architecture of perps platforms. And there is different ways of thinking about this. And I am just blatantly curious if you feel that Lighter has a or any regulatory advantage against other perps platforms, and why or why not?
Sure. So I think that our goal, and we've been spending time in DC the last couple of months meeting with folks kind of from the Hill, the White House, and the agencies. I joined the CFTC's Innovation Advisory Committee as well to help think through these things. Obviously our goal is not to have like some kind of unfair advantage. I mean, our goal is to help these folks who now actually are supportive of the industry and want to figure out the right rules and clarity. Like our goal is just to help them understand how these technologies work. I mean, ultimately, these decisions should rest with, with the regulators and the policymakers, but they should be aware of all the technologies that are available. So I'll give you an example, right? Like how should you think about KYC? I mean, I think there's a range of opinions on this, from like DeFi should have no KYC at all, to DeFi should have the same KYC as TradFi, right? And there are actually, there are a lot of interesting solutions in the middle, which in some cases the technology we've built using zero knowledge proofs works really well for. So for example, you can have something where, like a platform isn't actually tracking the customer's KYC, but there's some wallets that went through that process, or some kind of, AML check, kind of through a third party, and then those can trade particular products, or those can have particular counterparties, and that's all part of the same order book, but different rules in the order book where for example, let's say a Citadel doesn't want to trade with some types of counterparties, but maybe another market maker is okay with that, right? Like you can actually build all those rules into the order book with our architecture. So I guess to answer your question, it's not like it's not like rules will favor one participant or the other, but I think sensible rules will be easier to implement with certain architectures, and we think our architecture is a really good one for kind of the merge of when DeFi meets TradFi.
Well, that's kind of what I was getting at, Vlad, is I think that the way that you guys have set up the fee model and thinking about how market making happens on Lighter is quite differentiated from other perps dexes in terms of the types of fees, the way that the actual attraction of market makers happens as well. And there is just a growing worry that regulatory action could come down. And from smart investors that I've spoken to, part of their kind of Lighter thesis is that from the regulatory perspective, there's actually a much stronger stance here and a much stronger kind of moat in comparison to others. So I just wanted to ask about it.
Yeah, I mean, I think the fee model is one that, we've always believed that, trading should be free for the retail customer. I mean, that's actually one area where I think TradFi was kind of already ahead of a lot of the crypto space, right? And so I think that makes a lot of sense. But again, I think the way we want to think about regulation, right, is like, now that there are folks who actually kind of are, there's a lot of goodwill and folks who want to actually figure this out, as opposed to creating problems for the industry. There's a lot of opportunity to create rules that last, right? So the goal isn't just to have right now there are no rules, but then maybe in 2 years everything changes again. The goal is to actually have rules that are going to last and that make sense in different market environments, and that will work well for retail and for institutions, right? Because ultimately you need those institutions to provide liquidity. Like, going back to your point about real world assets, right? Like right now it's great that folks have access to these perps, but the way that it works in the back end is not as efficient as it could be, right? Because the market maker now, they still have to hedge that position on the TradFi rails. Now, if the kind of the TradFi institutions themselves could be on chain with a lot of these assets in a tokenized form, that's going to be a lot more efficient, and that's going to be ultimately, those efficiencies will be passed on to the retail customer as well.
Yeah. And which kind of brings us to an interesting point, Rob, because we had Logan Jastremski on, Vlad, and he's a notable Solana bull, and we kind of had this Hyperliquid versus Solana conversation, but it's really Lighter versus Solana as well. And he has this thesis that's localized ingestion is the future of trading on chain. Essentially what he's saying is that he does not believe in the Lighter model, or in the model of a single sequencer or a co-location being the main way that trading is going to happen at scale on chain. He sees it as more of a replication of traditional finance systems, in the sense that you have a central limit order book, in the NYSE, for example, they have a database in New Jersey where if you're, as close as possible to this database, you get, asymmetric information flow in terms of latency. And, he talked about how Hyperliquid's nodes are in Tokyo for in the majority. Lighter obviously has a sequencer, right? So like a single node. And he argued that the future is much more of kind of like this distributed set of nodes, essentially, and being able to optimize not for proximity to the central place of information flow, but actually creating a more diversified set of information from different players, where basically the ordering or the possibility of being the first one to get alpha from in terms of latency game is not necessarily because you are the one that's closest, but because that alpha was generated in a region perhaps closer to your validator or to your node. And this kind of goes about into all over in terms of global access. And I'm just curious, like, what your thought or pushback would be as to why this kind of co-location sequencer model is the way that you guys designed Lighter, rather than thinking about this kind of more distributed set. I think he called it localized ingestion is the kind of way that he framed it. How would you think about this kind of trade-off set?
Yeah, I mean, building, decentralizing the sequencer has always been on our roadmap, and so I don't disagree with that as a goal. The question is, what's the priority of it, right? Because, ultimately, like in 5 years, if you ask me how's it going to look in 5 years, like I think by then the sequencer will be decentralized. Is it going to be decentralized in 1 year? We'll see, right? Right now, that hasn't been a priority for the customers and the market makers. But once, because they're still like lower hanging fruit, right? As far as, different types of assets and, just overall liquidity, being able, kind of the right, structures for funding rates. Like there's a lot of lower hanging fruit before you get to the point where the only thing that's missing is like latency at the millisecond level. Once you get to that point, our architecture actually allows for decentralization of the sequencer in a pretty natural way, because with zero knowledge proofs, like one thing that's really nice about that is, as long as the proof is correct, it doesn't matter who generated it, right? So if there's sequencers running, one in Tokyo, one in New Jersey or whatever, like if any of them generated the proof of what happened, that it doesn't matter who did it first as far as the proof generation. But as far as the processing of the trades, we do believe that'll happen in a distributed way over time. We just don't think that's the lowest hanging fruit right now, as far as like when we talk to traders, when we talk to market makers, they just want to get more assets, get more liquidity, like have a really stable trading platform in terms of latency, in terms of funding rates, in terms of volatility, like leverage models, all of that stuff, right? Again, I think once all of that's figured out, we're actually very excited from a technical point of view to work on decentralizing the sequencer. Like if our team was just focused on like, let's solve the hardest technical problem ahead of us, that's what we'd be working on right now. The reason we're not is because that's just not what we're hearing from our customers as the priority.
Yeah.
So philosophically, we don't disagree with that, I guess, bottom line.
Yeah, makes sense.
And the market is aligned with that, right? Like the market's not been rewarding necessarily the most decentralized architectures as of the last year or two. It's really been rewarding protocols that have great UX, good product, make money, and do it at scale, right?
Well, I think our take on that is, yes, that's true, but also like I want to decouple like decentralization from verifiability, right? Like for us, it's one sequencer, but everything it does is verified, and the code for that is open source. So I think part of what you get from decentralization is the verifiability, which we have that already now, in terms of like the having a distributed system that can help some HFT firms kind of at the millisecond level. That's a different thing you can get. But just as far as the core value, which is that everything that happens is verifiable, and anyone can check it in an open source way, that's the big win that we kind of have had from day one.
Yeah.
Yeah.
And so there recently was a rather large influx of new customers from Telegram. You guys had this successful partnership. I think it was upwards of 23,000 new users. Really just an explosive growth moment. What was it that stood out about Lighter that, Telegram really valued? Right, we're saying it's not necessarily the, decentralization. What was it that stood out about Lighter that really captured Telegram and its users?
Right. Well, that's a good question because we're working on a variety of partnerships. We're really proud of the partnership with Wallet on Telegram, as you mentioned, and they're like, I think they do a really good job on their end of like building an ecosystem of traders, and they're rolling it out. It's a different type of trader than what we've had before, so it'll be a really complementary user base. I think it's one thing that's interesting about that is like their product is actually has some centralized components the way they've built it on the front end. Now, so a system that's verifiable and decentralized like Lighter can still be used in that framework as well. So from their perspective, they like the low latency, they like the low fees, they like how easy it is to integrate with, and I think our team has generally been very helpful to kind of work with these partners. So I think from their perspective, that's the part they like. So essentially, like if they think of like perps in a box, right? Like if you just want to introduce perps, like if your front end is centralized, you can it's still better to plug in kind of DeFi rails underneath than a centralized product underneath, right? Even if your own front end has some centralized components. So I think that's one interesting thing to point out, right? Because all the various partnerships we're working on, some also look like that, some don't, right? Some are completely decentralized on the front end as well. And again, touching on the regulation point, right? Like once we have a license, there'll be some players that actually could integrate with us that couldn't before because they require, like a broker can only integrate with an exchange that has a license, and maybe that broker themselves are are custodial, maybe that they're non-custodial, right? So there are all these different possibilities, and I think the bottom line is like the tech underneath works across the board, and we're very happy to integrate with any of these partners and work with them to make sure that kind of the solution provides value to their customers.
Yeah. And now that these users are on the platform, you mentioned that Lighter's got zero fees for these retail users coming from the Telegram wallet.
Right.
And I want to couple this with the Tom Lee earnings call I was watching a month or two ago, and he mentioned Lighter a couple of times, and so there's strong overlap in between the investment thesis into the Lighter token, as well as kind of the sudden influx of users. But given that there's no fees, how will the Lighter token benefit from the zero fee environment, or just generally, if you can't comment on token, how can the protocol benefit from these users, but the lack of fees from these users?
Right. So the for something like the Telegram integration, like all of their users, like they're coming in through this embedded wallet product, like they're all retail, right? Like you're not running a high frequency trading strategy through that app, right? So it's all retail. So then basically that's great flow to have for the market makers, right? So that basically what happens is like where Lighter gets revenue from that is on the maker fees. So there's the taker fee is zero because those are not premium taker users like an HFT shop would be, but there are maker fees there, and I think that that partnership even to date already has brought revenue that has been used for buybacks even just in the first week. So I guess in general with these partnerships we would kind of like we work with them to kind of revisit different, like how the fee split works. But in this case, I think it's pretty clear, right? It's like this is 100% retail. So, those customers, if they were trading through the Lighter mobile app, they wouldn't be paying taker fees either. But the maker fee is where the revenue gets generated there.
I got absolutely mollywopped on a trade I placed on mobile yesterday. I placed a trade on mobile, not on Lighter. I want to make that clear. It was on Coinbase. I don't have a problem calling them out. Just absolutely insane fee, and I think it was because I placed it on mobile.
Yeah.
Right. Right. I guess for us, like, it's more, we actually want to incentivize mobile usage, and we've seen that like mobile usage has gone up from, it was kind of below 10%. Now it's closer to 20%. Like, and that's going to go up further. We're going to release the V2 over the mobile app in the coming weeks as well. So yeah, we think like mobile is really important. I mean, that's one area where I think DeFi has been behind CeFi, right? Historically, is mobile.
Yeah. Yeah.
Vlad, I'm curious what you think about the valuation dynamics right now. Obviously, Lighter has just recently launched on the token front. People are looking at the token and seeing the amount that you guys have bought back. I think it's about 4% and growing. And it just kind of seems like as the valuation kind of disparity grows between Lighter and Hyperliquid, the case for Lighter becomes stronger and stronger. And then you also look at other kind of like revenue generating applications in the space, anything from like a Sky to an aerodrome to other kind of DeFi protocols, and you start to really see more of this disparity. What is your thought or thesis on this kind of valuation disconnect between Lighter and Hyperliquid? Like, do you think that there's something that the market is missing here? How do you think about this kind of state of valuations of perp DEX assets?
Yeah, I mean, I think like high level, it's good that the market is kind of valuing protocols that generate revenue, right? Like, I think a couple of years ago, we had, without calling anyone out, I mean, we had projects that had like revenue that was not even in the thousands, right? Like that where the valuations were in the billions. So I mean, I think it's a much healthier market now, and on a relative basis, I think like we're not like, we don't trade these tokens ourselves. Like, we're not macro traders. We're not like running a on-chain relative value fund. So I think there are others that do that professionally, that I think have done different analyses of it. But I will say, well, I think the market is figuring it out, right? It's like the idea of actually valuing protocols based on real economics, like that's actually pretty new to the industry, so folks are still figuring it out. But I think on our side, like there are three big unlocks coming up, right? One is kind of composability with the entire Ethereum ecosystem, which we haven't, like, we've been building on top of Ethereum from day one, but we haven't actually yet seen the full benefit of that yet. I mean, we have from a security perspective, but not from the composability perspective, and Lighter EVM will unlock that. So that's one big unlock. Another one is kind of actually having, working with TradFi partners to actually have a bunch of assets tokenized, where you can do things like the basis trade on Lighter. And again, I think that's, our architecture is really suited well for that, both from the efficiency perspective, but also because I think for a lot of TradFi, like the Ethereum security and verifiability is important. So I think that's the big one. And the third one is, like working on getting a license and coming to the US. So those are kind of three massive things. And so we want to keep our eye on the ball there. Like, maybe the market isn't pricing in the value of those. Maybe it is. I think, again, that's kind of up. I'll leave that to, professional analysts to figure out. But like that, those are things we're excited about, and we're here for the long haul. We're like, it's not about, price action in Q1 or Q2.
No.
It's like, are we building something that, like, if you're building something that has the potential to be a major part of the future of finance, I mean, that's like orders of magnitude bigger than any of the current projects today.
Yeah.
And as this sector continues to develop, you know, there's sort of this clear lead that you and Hyperliquid have. It feels like there's 1 and 2 and everyone else is chasing. Kind of feels similar to the prediction market space with Polymarket and Kalshi. As this power law tends to play out, how do you see this shaking out? Do you think this is a winner take all or a winner take most category, or do you think this is sort of a space where there's several players that can all have a piece of the pie?
Yeah, I mean, I think even if you look at like I think in general exchanges have, you know, whether it's in TradFi, right, between, you know, all the, you know, ICE and you know, CME and all the other folks there. I mean, if you know, centralized exchanges, you have your Binance, Coinbase, and etc. I mean, I think probably a similar dynamic will play out here. Again, like I think our vision is really exciting. We think that there's like these like macro factors between like again, think about it, like 3 years ago, something like Lighter, the tech for it just didn't exist, right? Like it wasn't possible to build. So now we have that. Now we have the TradFi actually, you know, wants to adopt, you know, DeFi rails, and I think a lot of TradFi is committed to doing that on top of Ethereum. And third, kind of the regulatory climate has done a 180. So between those things, like there's such massive trends here that I think, you know, we're very well positioned to ride those trends, and kind of where things shake out in terms of, you know, market share in 5 years, we'll see, right? And you know, we'll do our best. And I think it's good that it's competitive, right? Like building in a space that has no competition means you probably don't have product market fit.
Yeah. Vlad, I'm curious if your vision has changed over the last several months, right? Like we've obviously seen this massive rise of trade any asset on chain. I think a lot of us were kind of pigeonholing perps and DeFi protocols in general into just being applications for the crypto asset set. The, you know, $150 billion of TVL on chain, the $3 trillion of total market cap. But it's very clear now that we're going to be trading tokenized commodities, tokenized equities. There's going to be all different types of assets on chain, speculative, non-speculative. Perhaps you were always setting out to build a platform to trade anything, but how has your view on the kind of TAM of Lighter changed over the last several months, right? We've seen just a massive uptick in tokenized commodity, equity trading, etc. How has the scale of what you're doing here in your mind changed, or has it not really?
I think, yeah, we always, like, if you look at our pitch deck back from, you know, 2-3 years ago, we were always talking about how TradFi and DeFi will merge, and that's kind of the ultimate TAM here. So I think from that perspective, it hasn't changed, but the sequence in which it's happening is a bit different than we expected. So, like, I think our expectation was that a lot of the TradFi assets would get tokenized first, kind of as spot assets, and then you'll have a really strong derivatives market on top of them on chain. And until that happens, the derivatives market would exist, but it would be like pretty small, kind of like how prediction markets were a year or two ago, right? Like you could trade a market of like, is crude oil going to hit 100? I mean, you could have traded that market on the prediction markets before as well, but it was more of you know, an experiment. There was very little activity. So I think there was a little bit of like putting the cart before the horse here, where the you know, it's like folks want to trade. Like, I think the tokenization process is happening, so maybe a little bit slower than expected, whereas like the perpification process has been happening faster than expected. So some of these markets, it's like, okay, as long as you have a data feed, let's launch a perp market, whether the underlying is tokenized or not. And that's okay. I mean, if that's kind of how the market is playing out, like that's certainly something that we are adapting to, and we will, as soon as those underlying markets are tokenized, though, I think that we'll add them to Lighter, and we'll work with kind of token issuers to do that as well. Like we're looking as an example at tokenized gold as a spot asset on Lighter. Like imagine if you actually have that, you can do the carry trade on chain. Like again, we think that's kind of where long term the big opportunities from, like, because like right now for what's happening, it's like, yeah, you have these commodity perps, but then you know, someone has to hedge those on the TradFi rails, and I guess the good news is that the demand is so high that even with that inefficiency, it's still a huge market. But imagine how big it would be if you didn't have to duplicate it, and actually it was primarily happening on chain. So that's still the long-term vision. It always was, but the sequence of how we're going to get there is a bit different. And you know, we have some very you know, sharp competitors here, right? So that's ultimately that's a good thing.
Yeah, man. I mean, the volume of on-chain trading of non-crypto assets, it's just kind of crazy to think that could be the dominant form of Lighter. Like it could just be a massive global stock exchange where crypto is a small amount of the volume as it is today.
Right. Well, that's interesting because now that seems obvious, but yeah, like we actually made that pitch 2-3 years ago. At the time, it was like, okay, that's cute, but like, okay, what are you guys doing for, you know, the core crypto assets, right? But I think that, you know, I think the big shift there is like the around how TradFi looks at these assets and kind of how regulators look at them as well, right? Like it's night and day. And I mean, I think ultimately like DeFi rails were always, it's like the internet, right? Like initially the first, 5-10 years of the internet was primarily like the content or you know, the products that were all kind of from within the internet. There were no like real world things. And then all of a sudden you had things like Uber and DoorDash and all of that, right? So you kind of, I mean, these rails ultimately are meant not just for their own ecosystem, but for the wider, for the wider market. And so that was always our bet. I mean, the sequencing in which it's happening is a bit different. We're learning a lot from that and kind of building towards where the puck is going.
Yeah. And it's a process and a journey. You mentioned that on this journey, there's a couple things coming up that the market may or may not be pricing in. There's 3, including the US launch, as well as the Lighter EVM and unlocking full composability. What's coming up next? And can you just speak to the scale at which you think these things might change the game?
Yeah, so the Ethereum story is that there's like, give or take, 100 billion in TVL kind of on the Ethereum ecosystem, right? Like if any of those assets can be used as collateral on Lighter, that's kind of much bigger than kind of anything we have today or anything our competitors have today, right? So that's a huge unlock. And the timeline for that is, I think in kind of the 3 to 6 months range. And then, some of these partnerships with TradFi may, some of them will be pretty quick, some of them will take longer, but I think again, if it's something like the Telegram partnership where it's more of like kind of giving customers easy access to perps, those might go faster. The ones where kind of full tokenization is needed, that's a bit slower. There's still some stuff that has to be worked out with the Clarity legislation and all that. But again, it's gonna happen as well. And then we're on the US side, we're working closely with the CFTC to make that happen. So yeah, I mean, I think by the end of the year, we are, I think we could be in a really strong place across all 3, and that's what we're building towards.
Yeah. Vlad, one last thing. I know we're running up on time, but you mentioned the CFTC working closely with these guys and being part of this innovation council. I realize that there's this innovation exemption that's sort of on the horizon as well. If this is to go through, we saw Citadel and some others maybe, pursuing litigation against the CFTC as a result of this. So it seems quite significant. If this thing goes through, this innovation exemption, who do you think is the biggest stands to be the biggest benefactor of this exemption?
Right. So, I mean, the exemption language, and I mean, I think Citadel, they're weighing in on kind of what's in like there's some things that are in the legislation, and there's some things that'll be worked out by the agencies, right? So, I think, I think right now and we understand their perspective too, right? Like I started my career at Citadel, like I think TradFi in some of these cases has a legitimate point as well, right? But I think the innovation exemption, I mean, I think it's the Innovation Advisory Committee and the innovation exemption, are unrelated, right? The committee is actually kind of pretty, there's a lot of very mature companies there, but just everyone is some smaller players like us, but like everyone who's thinking about innovation and how to regulate everything from perps to prediction markets to AI agents on chain, all that. The innovation exemption, my read on that is that that's meant more for like really like let's say someone was starting a new DeFi project like right now, and they don't have a compliance staff or legals, they just want to build something that a few thousand people will use and see if it works, like that. There should be exemptions for folks like that, right? Like protecting developers, protecting those innovators, just to build, a V1 or testnet or something, right? Like, 'cause before, even folks like that would be scared to build in the US, where that shouldn't be the case. Now, if it's a product like Lighter that has hundreds of thousands of registered users, and we have, real revenue and resources, like I think we should have a path to registration, and now that should look different than a TradFi exchange, but again, our goal is to actually have institutions from the US trade on Lighter. So we don't view the innovation exemption as meant for necessarily players like us, but more for like somebody who's just starting out, building something, experimenting, innovating at the very early stages. That's my take on it. But I think there should also be paths for kind of more mature projects as well, and we're very happy that the CFTC is kind of very thoughtful about all these paths.
Yeah. Well, Washington D.C. is a shark tank, so we appreciate your hard work there and fighting it out for the industry as a whole. Not everyone has the opportunity to send some representation up there and do some of the good work, kind of pushing the regulation forward. So. Appreciate you doing all the hard work in Washington, D.C. and spending some time with us today.
Well, thank you so much. Great conversation.
Lighter looking good here, guys. Let's give Vlad some love. Thank you, Vlad, for coming on, man. Speak to you soon. Best of luck. I know you're slammed, man. And have a good weekend, buddy. Cheers. Alrighty, guys. Our next guest is Greg Osuri, the founder of Akash. Take a quick commercial break. Rob's going to talk to Greg, and we're going to get the show right back on the road, guys.
I'm looking forward to it. Greg is a homie. I like his hat that he came on with in San Francisco. So
Dude, yeah.
We are looking forward to chatting with Greg here in just a little bit. We'll be right back, guys. Alrighty, we are back. We are here with Greg from Akash. Last time we had Greg on the show, it was in NearCon in San Francisco. Greg, I remember, man, I think we said hello, and then you went on like a 20-minute rant about the entire configuration, GPUs, local LLMs, like everything in your house, and had, wild stories about how these things were. They knew you were going to wake up before you actually woke up. They started your coffee machine. You had cameras on the cars outside trying to detect abnormalities. I'd love just a catch up on how you're doing. First off, welcome to the show. But then also, how you're doing and how your house is doing, this entire configuration.
Oh, I am doing fantastic, but little underwhelmed with, or rather overwhelmed with the little lack of time for all the things I want to do, because the last few months I feel like if there's a way to replicate me, I think we can solve world hunger.
What are like the 3 bucket list items you have up at the top of your mind right now, high priority?
Well, besides the Akash,
Yeah, like the things that like if you could
priority.
have a few replications of yourself, like what would Greg A, B, and C be doing?
Farmland.
Yes.
I've been feeling it more and more lately. The more and more I see agents going, taking over. I mean, I feel like I can't shake off this thought that anything that's digital, without a non-tangible value attached to it, I'm talking about a digital item without a brand attached to it or a community or a network attached to it, will be worthless.
Okay.
So if as a human being, only thing you have to offer is a digital good, I think that'll be worthless sooner, much sooner than we think. Considering how good these agents are getting, how fast they're getting better, I just don't see a place for, say, a software engineer that identifies themselves as a front-end engineer or a back-end engineer. I just don't see people that are sitting at desk jobs, clicking buttons. I just don't see a future for them.
Yeah.
And it's kind of scary. I'm pessimistic in the short term and optimistic on the long term, right? So I think there's going to be quite a lot of. I mean, I was very pro AI, like expansionism, but the last few months, I think I've taken a little bit more thoughtful, approach of like, what are we going to do with these people? The displacement's going to happen, right?
Yeah.
In my own company itself, we're seeing quite a lot of like displacement. People that consider themselves as builders in the sense that, they look at a problem and they go beyond what their knowledge is limited to, and be curious about how you can take a unique approach or a broad approach to solving a problem versus people that identify themselves as experts, right? Because all this while, the advice we've been giving or we've been getting for the last 20 years is to specialize in a subject. That's the advice you give for folks that are coming out of college. But now it seems to be the opposite. Don't specialize. Go broad. Be jack of all trades, because your ability to specialize is no longer valuable because AI is much better at specialization. Like AI can solve math problems much better than me. AI can write better code. I've been coding for 25 years. AI can literally write better code in terms of schematics of the code much better than me. I'm not talking about logic, right? There are a lot of like specialized skills that AI will replace much more rapidly than I anticipated. And that's going to cause displacement. And ultimately, I think my opinion is because AI is a force multiplier, right? So for people that have a lot of ideas and have a lot of aspirations, AI it's a perfect companion. So people with that mindset will be able to a lot more, means that there will be a huge demand on resources that unlike anything else, right? We are already seeing the demand in, like, look at AI data centers alone. First, we saw a chip shortage. Then we are seeing a memory shortage. Memory has gone up 4 times the cost, HBM memory especially. Then we're starting to see energy shortage. I mean, we can't even buy a transformer without waiting 4 years. We can't buy a turbine without waiting 14 years now. The amount of stress on resources, anything AI touches, is just unbelievable rates right now. So, and I think that's going to trickle down to the fundamentals, which happens to be food, shelter, and water, right? That's why when I said farmland, because I think that's the ultimate safety bet you can actually make if you have food to eat and shelter and water, and farmland will give you ample amounts of opportunity to capture solar or whatnot. And even have data centers or small build outs with Akash home node coming along very soon. I'm very, very pro rural and less urban. That's what's going on in my mind right now. That's not and everything ties into, right, the work we're doing with Akash, and recently we announced home node as a solution to this energy problem, where we, as it predicted several years ago, the energy is going to be bottleneck. I testified before Congress about it. And yesterday, OpenAI canceled their plans for new data center buildouts. Why? Because they cannot get energy. It is happening right now, right? So, and it's going to continue happening, right? We're going to see a lot of cancellations, and I'm afraid all the big leg up we got with GDP growth in the last quarter is going to be canceled this quarter, because you're going to find out building data centers is not as easy as it seemed to be back then. People like Elon Musk are proposing going to space. They're basically giving up on Earth, which I think is a little bit of a stretch there. But bottom line is, the energy problem is becoming so pervasive, we have to do something about it. On the bright side, distributed trading actually is taking the center stage. We saw a new model by a subnet in Bittensor called Covenant, which did a 72 billion parameter model, which is not state of the art, but definitely better than what Llama 70 billion parameter model was, right? So we're starting to see incredible progress in distributed training and distributed inference. So it's not hard to see where you have a distributed grid, and that grid contributing to a larger distributed network for AI as a possible solution. We saw Jack Clark, from the co-founder of Anthropic, talk about distributed AI training. I've been talking to several labs. I don't want to name specifically who they are under NDAs. Everybody's looking at distributed training as a serious potential, and I think if we figure out an incentive structure for distributed trading, I think that's where crypto does a phenomenal role there. I don't see how distributed trading will take main stage in a couple of years. And when that happens, bet you want GPUs and a farmland.
Maybe we'll circle back to the farmland, because I think that does pique some interest, and I want to get into kind of your theory around labor and dilutive digital goods and that sort of thing. But you mentioned BitTensor and the decentralized AI training. I want to dig into this because you're right. Covenant just announced yesterday, they not only did they, have the 72 billion parameter model, they also announced that they're leaving BitTensor for a variety of reasons. And so, because Akash and BitTensor both fall into this decentralized AI stack, I'm curious if you could first untangle these two, just kind of maybe compare, contrast Akash and BitTensor, and then, tell us your reaction to Covenant and, them leaving BitTensor.
When you say decentralized AI, it's a broad sector, right? And there are several layers for decentralized AI, right? So let's start with, we can go as far down as we want in terms of abstraction. Let's start with energy, right? Okay. Ultimately, AI needs compute, physical resources. Compute needs energy, right? Energy means, energy needs other things like transformers and turbines and whatnot. So if you start with the top, right? So the way you access AI, there are two main aspects to AI. There is training and there's inference. Training is how you build a model. That means you take raw data from the internet and you train a model and you make it usable. And there are several steps with pre-training, post-training, all that stuff, but ultimately training is training the model to answer your questions. And inference is when you use the model. So when we say we're using a lot of tokens from Claude or whatnot, that's basically inference. You're not training much, right? And so that there is that layer that there are obvious reasons why you want inference to be decentralized because, well, control. I mean, look at today. Claude in the last week or a few weeks ago, Claude, Anthropic Claude happens to be the best state-of-the-art model for a lot of reasons. I mean, they're phenomenal at coding, and they're amazing when you use it with OpenClaw of the world, right? But they announced yesterday or last week that they're going to ban OpenClaw usage. I mean, OpenClaw has been the most successful open source project in the history of humanity, and the reason why it's successful is because people love it. So when you have the most powerful model in the world basically come out and say they're going to ban, for reasons set aside, and they have their own reasons, whatnot, but they're going to ban the most loved project in the history. What does that tell you about where the incentives are, right? So that's just one example as to why you need unlimited, untethered access to intelligence. Intelligence should be a commodity that is free, like water and air we breathe. Being controlled by a company or group of individuals that serve in their best interest is not aligned with the interests of the world. And that's very simple, very straightforward. On top of that, transparency and we have no idea the biases that the Anthropic has developed, right? Sure, it's a really good coding model, but what about if you're going to say that intelligence, from these models are going to directly impact the way I make decisions? I want to make sure that that decision tree is not corrupted, right, with biases that may not align with my values. So there are a lot of reasons why you want to decentralize the training and the inference side of things, right? And that there's privacy. There's a lot of reasons why you want that. So there is that layer. And second is, for both inference as well as training, you need compute, right? So if the access to the compute is not as easy as it should be, then you're going to create incentives in the middle layer, like that control the supply of compute, right? So Amazons of the world, we saw very up in 2023, 2024 era, when ChatGPT basically came and became super popular and mainstream. That created a lot of interest in AI. A lot of developers started using AI. And now, obviously, cloud was the first place you go to get GPUs or compute. That's what we did in the last 20 years. For the first time, we saw cloud no longer works in your best interest, but rather gives compute to people they think are going to be successful. So, one might say Amazon, again, no, this is speculation, but Amazon overwhelmingly supporting Anthropic might have, resulted in their success, right? So who's to say cloud companies are not picking winners and losers, right? Yeah. So, and during that time, no startup, they literally paid, literally gave compute to people that they thought are going to be successful. And there's some investment that happened, all kinds of, deals that happen, and guess who are left out? The developers that are actually, wanting to get these chips. So we cannot have an uneven playing field if we have to have a fair competitive world, especially for something like cloud, which touches every aspect of our life. This particular stream is, controlled by the cloud, right? Yep. And we have fair pricing and transparent pricing for electricity and water and all the commodities that we use and depend on. Why not have the same mechanism for the cloud? And we don't want a state actor to enforce that, but rather a free market to enforce it. That's the thesis of decentralized compute, right? So there's that layer of decentralization, of getting pure access to compute. And third layer of decentralization, I would call it, is energy, right? Energy is a very interesting area. It's a lot harder to decentralize energy than the previous two layers. Why? Because Well, we can't just produce energy in one place and transmit the energy. We can't even, the way you transmit is through the copper wire, right? The grid. And our copper wire grid is extremely fragile because there's a limit as to how much energy can be transmitted on the physical limit, right? By the size of the wire, so the transformers, the heat and whatnot. So you can't produce energy and transmit it elsewhere, even though you have solar at home, whatnot. But if you put a GPU on top of it, now you abstracted the energy. When you abstracted the energy in a GPU that you can pass around, the computer can pass around, right? So, but the ability to produce energy and abstract the energy into a compute where you're doing useful work for in AI workload can be considered as a way to decentralize energy. I mean, same thing we saw with Bitcoin, right? So Bitcoin, one way to look at Bitcoin is a global load balancer, right? Energy load balancer, right? Because when you have areas where you have excess energy, most renewables do produce uneven spikes of energy. When you have excess energy, you can use that energy to mine Bitcoin. And when you want energy, you can use that Bitcoin that you bought to get more energy. So it becomes like a global load balancer. Same concept extending to AI. When you have excess energy, you trade using AI, assuming there's some way to transmit those tokens. And then when you want the energy, you can use those tokens to get back. So so there's that level of decentralization, right? So Akash comes in the middle there. Akash comes in decentralizing compute by relying on excess compute around the world. And there are several protocols now, which I'm very excited about. Daylight Energy is a good company. There are a lot of energy decentralization plays that will perhaps use something like Akash on top of them to create a more distributable grid in an undistributable physical layer, right?
Yeah.
So now BitTensor, the big difference between BitTensor and Akash is BitTensor is creating incentive network for different aspects of AI. So be it, you want specialized models for doing, science research. You want inference. You want compute. You want storage. You want so many layers that will contribute to a training or inference run. Now, BitTensor is trying to create a network of these subnets, they call them, right? That do specialized things. Now, can these subnets exist without BitTensor? Absolutely. They can exist outside on any other decentralized network. BitTensor in particularly not focused on I would say, the decentralization of the subnets in the sense like if you have an inference provider on BitTensor, it's not necessarily decentralized. It still is an entity that's connected to the network. It's an incentive layer. Now, is there any advantage for Akash or someone that's established in any other distributed deep-end network or any other established Helium or Render or any of these networks to be on BitTensor? I don't think so because we looked at it pretty seriously. I mean, I'm a tab holder again. I love the community and all the good stuff. But the question when I ask is there what's the advantage? Is there interoperability advantage? Is there a orchestration advantage? Is there some form of advantage that is ideal for established systems, not systems that are starting out? It didn't seem to be. But is there an advantage if I'm someone new? For me to start, get incentives, get token emissions and whatnot, that actually incentivizes my initiative. I think it's a phenomenal advantage. So if you're starting a new AI project, I would definitely choose BitTensor as a great platform, and hope the network will evolve to a point where it can keep the subnets after reaching a certain level of success. And we saw that with Covenant. Right? Obviously, there's a misalignment in incentives once you reach success. And that's a question I think doesn't seem to have a straight answer at this point. But given their track record, given the team values, given a lot of the technical capabilities, will they figure it out? I think they will. And that's where I stand with BitTensor. It's a big difference. Akash is more specialized. Akash is direct. You get compute, you get storage, you get IP addresses, you get a lot more things that you normally can't get, in a single place. And Akash is that layer right now. Will we have subnets? Yes, there is. In our roadmap, we talked about managed services since like 5 years ago, and we're continuing going down the path. But we think, in order for us to have subnets like services on Akash, you need to have a solid orchestration and coordination, orchestration and interoperability layer. Meaning, if I were to use, say, a vector database, or if I were to use a SQL database, if I were to use a caching layer, if I were to use a load balancing layer to build out my software stack, right? I should be able to have a single orchestration language. In Akash, we have something called SDL, or stack definition language, where I can define the services, pay for the services, scale them, monitor them, control access and whatnot in a unified manner, so that it's easy for the developers, it's easy to maintain, it's easy for a lot of people, and there's clear advantage and for the user side, you don't want to be paying in different tokens, and you want to come and pay in one single token. Ideally, have some sense of stability in terms of value transfer, and use services like you would normally use Amazon Web Amazon Stack or whatnot. So that's a big difference as to where BitTensor and Akash differ.
Makes complete sense. Thank you for not only illustrating kind of the differences between the two protocols, but also just illustrating the entire stack, because it is quite broad, like you talked about, and also why Covenants might be leaving the BitTensor ecosystem now that they've hit some scale, and the ecosystem over there seems like it's built primarily for some of these earlier projects, so that they can help find some initial fit into the market. Greg, I think we've got time for maybe one more question. I know we're running up on time, but I wanted to ask you about Mark Andreessen, who recently he went on a podcast, I think it was today or yesterday, just recently. He said AI is the killer application of crypto. Now, given that you've just illuminated this very broad stack of AI, what do you think is it that he's talking about? Is it the payments element of it? This machine-to-machine payment economy that we've been hearing about? Is it the compute? Is it the inference, decentralization? What is it in the AI stack that is most fit for crypto disruption?
That's a great question. I mean, he's right on the money, and this is something I've been talking about or thinking about quite a lot. I think it comes down to identity and sovereignty and custody, right? Like when an agent wants to, in a Akash example itself, wants to go deploy something, he wants to build a stack, right? Will it go to Amazon Web Services and sign up for an account and wait for approval, wait for money? The credit cards, there's a whole lot of bootstrapping aspects you need to have. I'm not saying it's not possible, but it's extremely challenging. Versus go generate a key locally, use that key, and figure out how to there's so many ways to bootstrap in crypto. Use that key, and there's no limit as to how many keys you can create and how you can propagate and how you can deploy. No one's going to stop you from doing that, right? So what's most likely to be used? Of course, getting a key and getting a wallet, that's frictionless for human beings, but not for an agent. So I think that coming from that aspect, and there's so many opportunities to make money in crypto, right? Like, there's so many opportunities, arbitraging opportunities. So I think I haven't seen a podcast, but if I were to guess what he's thinking, I think, because crypto is hard for humans to use and not AI agents to do, and it's perfect for custody and identity that agents don't have in the real life. Getting a Amazon account for a human being is hard enough, right? Like, you can imagine how hard it is for cryptos, for AI, sorry. So it makes total sense, and payments obviously is a big thing. And there's a lot of standards now. It's hard to pick who's a winner. One big question nobody cannot answer is okay, what happens during a fraud scenario, right? Like, for example, if an agent goes and does something dumb with a credit card, and credit cards have a mandate to charge back, we get a lot of having credit cards on top of crypto products, you get a lot of fraud right? How does one deal with fraud with the agents? With crypto, there's no, I guess there's no rollbacks. Right? Once it's done, it's done. So a lot of questions that are still now. Will people figure it out? Probably. People are smart. I mean, maybe they will figure out how to do fraud management, but there are no clear answers now that in the traditional finance world, but the clear answers in the crypto world. So I think from that angle, AI agents using crypto is very obvious. And we're already kind of seeing with Akash too. There are a lot of agents now using Akash, like for deploying and whatnot. And we are kind of optimizing agents to use Akash more because we see a untethered access. I mean, we see incredible growth for agents, but also like you can see a world where if you're an agent, you get discounts too, right? So, and we're working with the protocols to like proof of humanity. You can clearly see a world where agents will be given higher priority because they may generate like bigger, much higher revenues, and humans lower priority. I mean, there's a lot of really interesting things that I'm seeing potentially happening. I mean, it's still early to say what path, but it's crazy right now.
Your insights on the entire AI stack, and I'd love to have you back on after some more of these partnerships with labs become more public and continue to develop. So hope to have you on again soon.
Of course. Thank you so much. Appreciate it.
See you, Greg. Thanks.
Bye.
All right, guys. There we go. That's about it. I think Andy's gone. We're going to close today's show. That's a wrap. Franklin Templeton, Greg from Akash, great guy. You can tell this guy just likes to go on rants, and he's really, really good at it. It was a pleasure to, basically hear how these decentralized AI companies, these crypto AI companies are starting to work with some of the larger labs, still under NDA, but I have a feeling a lot more of that is going to be coming out soon. You saw NVIDIA, and Jensen is already aware and thinking about, okay, we've got this thing called Tau, this decentralized inference, decentralized compute area to the AI stack. And so they're certainly thinking about it. And then you've got obviously Mark Andreessen, which we covered today, talking about how AI is the killer use case, killer application of crypto. So this is part of the convergence. We've been talking about the convergence as the collision of the two worlds, the on-chain and the off-chain economy, ultimately just becoming finance. There's a third meteor that's coming in, just going to strike this convergence. It's a three-way convergence with AI as well, and AI converging with crypto. So you've got on-chain economy, off-chain economy, and AI all just slamming together. That's when we reach the singularity. I don't know. It's the convergence. It's happening right here on the Rollup. Guys, thank you so much for watching. And it's a Friday, so have a good weekend. And we will see you same time on Monday. See you guys then. Peace.